All right. So extrinsic value, everything you need to know. I am a firm believer that if you understand extrinsic value, and this is what I talked about in my first trade talk, the Pareto principle of extrinsic value, which is basically the 80-20 rule. If you know that something like extrinsic value, if you can understand that fully, you really are understanding 80% of all the other things that we talk about. So if you understand extrinsic value, how it changes with implied volatility changes, how it changes as time passes, how it changes relative to where your stock price is relative to where your strike is, you are really understanding vega, delta, gamma, theta, all the Greeks all come back to extrinsic value, or most of them, I should say. So let's dive in, and hopefully this is helpful.
Cool.
All right. Extrinsic value basics. Extrinsic value is the time and implied volatility value of an option. It is any remaining value of an option that is not intrinsic value. So if an option is in the money and has intrinsic value, which basically means that it has some kind of real value at expiration when all extrinsic value goes to zero, if there is any value over that intrinsic value, that is your extrinsic value, which also means that all out of the money options and at the money options that are not yet in the money, the 100% of that value is extrinsic value. Now, when you look at this big yellow bolded section here, time value plus implied volatility value equals extrinsic value. This is just a general idea of how this works. There's going to be shifts in how powerful these two things are when it comes to time value and implied volatility value. We have laid out many, many times that when you have an option that's expiring, but it has an earnings announcement, there's going to be tons of implied volatility value there. And you're not going to see much time value because the option's about to expire, which is why you see these crazy inflated implied volatility numbers for earnings announcements and expirations that are about to expire. Yep. The opposite is true if you're looking at very far out of the money options in time, like leaps with 300 days, 600 days, 800 days to go. Most of that value is going to be time value. There is still some implied volatility value baked into it, but we shouldn't expect to see that implied volatility number really change too much. So when you see the market selling off like we have recently, what you'll see in something like SPY is that the near-term expirations, that 30 to 60 days, or really 0 to 60 day expirations, those are the ones that really get inflated with implied volatility. Those back months, the actual IV number doesn't really change that much. It still changes, but not nearly as much as the near-term cycles that are much more implied volatility sensitive.
Yep.
Extrinsic value in general is always going to be highest at the stock price. If we're talking about a regular equity, we're not talking about the VIX or anything like that. Extrinsic value is always going to be highest at the stock price. And this is why. It's because at the money options, right at the stock price, have the highest uncertainty of whether that option will be in the money or out of the money at expiration. If you think about it that way, it makes your life a whole lot easier. This also explains why not only out of the money options, but also in the money options have very little extrinsic value relative to at the money options. And that's because their fate of remaining in the money or remaining out of the money is much more predictable. And that goes directly in line with probability of in the money and out of the money and how extrinsic value plays into that. So even though an in the money option will be worth a lot more, it's because it has a lot of intrinsic value, not extrinsic value. And out of the money options will be far less valuable than at the money options because out of the money options have a higher certainty of remaining out of the money at expiration. We covered this yesterday, implied volatility and standard deviation. So just a real quick recap. If you have a low implied volatility environment, you're going to have more narrow expected moves from a one standard deviation standpoint. If you have a high IV environment, like this second image here, with 80% IV, which is more than twice as much, for that same one standard deviation range, you're going to have strikes that are further out of the money. So when you think about extrinsic value, in the 30% IV, you should think of it as this umbrella, which we'll talk about in a second. But think about it as a narrow umbrella with the extrinsic value really concentrated around the stock price because the implied volatility is low. In the 80% IV environment, you're going to see more extrinsic value at the money, but you should also expect to see more extrinsic value out of the money on the strike plane for both the call side and put side, because the market is projecting this product to move much more.
Yes.
So
less of a drop off.
Yes. So not only will the 1 standard deviation range be wider in the higher IV environment, you're also going to be able to collect more premium looking at the same strikes, or move your strikes further out of the money to collect the same premium. So in any product you look at, if you're looking at two stocks that are similarly priced, if you have a 30% IV product and an 80% IV product, and you pull up the November expiration, without even looking at the options, you know that the 80% IV product is going to have more at the money premium relative to the 30% IV. You also know that if you're looking at strikes 5 points out of the money on either side, you will collect much more in the 80% IV environment than you will with the 30%. You also know that if you're just trying to collect $1 or $2 or whatever, you're going to be closer to the stock price in the 30% IV environment than you will in the 80% IV environment, because of how the market is projecting this product to move. So it's not necessarily what we covered yesterday was looking at the same value, moving your strikes out of the money. I added this in here too. If you're looking at the same strikes, you're going to be collecting much more, and you can actually estimate how much you might be collecting more. So like if I had a 30% IV environment where I was collecting $1 for these strikes, and then I look at the same expiration for a similarly priced product, and that expiration is 80% instead of 30, I might be looking at somewhere around 275 for the same strikes, because the time is the same, so that's not changing, but the implied volatility is about 2.5 times more than what we're looking at in the 30%. So it's safe to assume that if I'm looking at $1 in the 30%, I'm probably looking at 275, 280, 260 in the 80% IV.
Assuming the exact same stock price.
Correct.
Yep.
Here's where it gets a little juicy.
This is the one I like.
It's a good one.
Yeah.
It's a good one. So we've talked about this many times, and we've actually done data-driven visuals for the same idea. I remember we were looking at
when we did this, the spreads. When we did the spread one.
Yeah, when we were looking at premium based on time versus IV, we had a similar result here. But from a theoretical standpoint, this is what we're looking at when it comes to time versus implied volatility-based extrinsic value. So implied volatility-based extrinsic value is going to be much less linear than time-based extrinsic value. If you just break them apart and separate them from an ideology standpoint, your time-based implied volatility or time-based extrinsic value is really about what can happen with this stock price given the amount of time that we're giving the stock price to move. So if you're just looking at time, if you look at a 30-day expiration versus 60-day expiration, 60 days is twice the amount of time for the product to move. So you must have more extrinsic value in the 60-day than the 30-day. It's much more linear, and it really drops off pretty dramatically as you get closer to expiration. So this bottom left corner here is expiration, and we're pushing that through time to show you the total extrinsic value here, which is the vertical axis. And this is linear in this image, but it's really not linear in real life. It's going to still have some kind of slope to it.
Yeah. We're talking theory here, Mike.
Yes. So if we look at these two graphs here, so the total extrinsic value is this blue shaded solid line here. But if we are to consider the relative time value, time-based extrinsic value and implied volatility-based extrinsic value, you'll always have much more implied volatility-based extrinsic value as you get closer to expiration, which is why we talk about selling premium between 30 and 60 days. 45 days is really when theta starts to kick in. And that's because you get this drop off in time extrinsic value, but implied volatility value could be high and then contract. Like this yellow line could be moving up and down, where this red time-based extrinsic is likely not going to be moving too much at all. It's just, it is what it is. But this IV-based extrinsic value is going to be moving up and down depending on what's happening in the market. So at the end of the day, implied volatility-based extrinsic value is always going to outweigh time-based extrinsic value as you are getting closer to expiration. So think 0 to 60 days. As you get further out in time, implied volatility-based extrinsic value gets much less impactful, and time-based extrinsic value starts to take over. And this is because if you think about, if you're looking at a year-long option, how many earnings announcements will that option go through? Multiple.
How many big down moves, big up moves?
Yeah.
There's just a lot more variance in the relative outcomes. Whereas a 1-day option or one that's expiring, in a couple days this week, it's a 50-50 type coin flip.
Exactly. So when we're looking at earnings announcements, and this is where people they misread this. When you're looking at earnings announcements, or let's say there's an earnings announcement looming, you will see an increase in implied volatility, the number itself. So this is what we're talking about when we see the IV spike leading up to earnings. This does not mean that extrinsic value is increasing. Extrinsic value is going to be decreasing unless there's some kind of crazy implied volatility expansion for some reason that you cannot predict.
Yeah, the change in implied volatility would have to offset the decay of that option based on whatever time frame. So if you're looking at like 2 days before earnings relative to 1 day before earnings, assuming the stock stays basically flat and you have a little bit of a vol increase, those options probably don't change that much. But if you're looking at a trade 30 days before earnings versus one that's 1 day before earnings, there's a ton of time decay built into that 30-day extra time that you have on that position.
Mm-hmm. And if we have an earnings announcement that's coming up, what you'll see is, like, let's say that this is a regularly sloped decay as you get closer to expiration with no earnings. If there was earnings, let's just imagine that this blue line here is much more flat. So time is still passing, but the value of the option, while even though it's still losing value, it's not losing value as much. Let's say it's losing value 10% less, 15% less than if you did not have earnings. What is that going to do? Well, because the option is holding on to extrinsic value, but time is still passing in a linear way, that must mean that you will see an increase in the implied volatility number, because the option is not losing value as much as it should, because there's earnings looming, but it is still losing value. So if you're looking at options right now, and you're looking at like Apple, for example, and you're looking at 10 points out of the money on either side, if you look at the value of that option today and you compare it to a day before earnings, and you look at 10 points out of the money from that new stock price, you will have a lower value. It might not be drastically lower, but it will be lower. So that's where this IV spike comes from. It does not mean that extrinsic value is increasing. It's not. All else equal.
Yes.
But because the option is holding on to value a little bit more than if you did not have earnings, that's where that increase and infusion of the implied volatility number comes from. So hopefully that makes sense. All right, so here we go with talking about extrinsic value around the stock price. So again, extrinsic value is always going to be highest around the stock price if we're talking about a normal equity or ETF, something that's not like the VIX, where it's a forward-looking product that looks at futures. Again, this is the reason why extrinsic value is highest at the money, is because this is the most uncertain spot to where that option will either be in the money or out of the money at expiration. So think of that as uncertainty, but also think of it like an umbrella. I can't figure out a better way to describe this, so the umbrella takes the cake. The umbrella following the stock price gets taller and wider if there's an IV expansion, or if you're just comparing a low IV environment to a high IV environment. So these images here, this near expiration, this purple one, just imagine this total extrinsic value being at like 45 days. As you get closer to expiration, the total at the money extrinsic value will decrease, and the tails will also come in and get to zero first. You could also consider this like this blue line being 100% IV environment and this purple line being a 15% IV environment. The at the money value is going to be significantly lower with the low IV, and the tails aren't going to be as far out of the money relative to the stock price because the implied volatility is just not there. The extrinsic value is not there. Eventually, all extrinsic value collapses in on the stock price, which is why out of the money options and in the money options lose their extrinsic value first before at the money options. So this is why when we're selling strangles relative to straddles, we expect to make 50% on strangles significantly faster than 50% on a straddle. That's not only because the straddle, of course, will always have an intrinsic value component, but if the stock just stays right there and doesn't move, the straddle is going to hold on to extrinsic value much longer than out of the money options that could go to zero significantly more quickly. All right, so we've got a couple of more slides here, but these next 3 slides are just the general ideas that I think you need to hammer home when it comes to extrinsic value. So we talk about gamma risk all the time. Gamma risk is the rate of change of an option's delta given a change in the stock price. So we talk about rolling at 21 days to avoid gamma risk for undefined risk positions. Why? Why is 21 days this magic number? I would say it's not. I can give you examples as to situations where your gamma risk would still be pretty low, even if you're at 14 days or 7 days.
Spreads and tighter positions.
Well, even naked positions. If there's high implied volatility and there's still plenty of extrinsic value, your gamma risk is still going to be low because that's the key. The reason why gamma risk is high as short options reach expiration is because of the lack of extrinsic value in the option. As an option moves in the money, it loses extrinsic value and gains intrinsic value. So if there's no extrinsic value to lose, your worthless option or close to worthless option gets up to dollars very quickly. So if you have a 10-cent option and it moves 2 points in the money at expiration, your 10-cent option just went from 10 cents to $2. But if you have $2 of extrinsic value at the money and the option moves 2 points in the money, you're going to gain that $2 of intrinsic value, but you're also going to lose a little bit of that extrinsic. So maybe your $2 option goes to, I don't know, $2.50, $3.
And you're talking about the change in value relative to your position, going from a 10-cent option to a 2-cent or a $2 option. It's $1.90 against you. You go from a $2 option that goes $2 in the money, and maybe the extrinsic value comes in, 50%. You only lose $1 on that option. So it's a big difference on that position, relative to your P&L. So it's a big swing in terms of P&L volatility, not only, the delta change.
Yeah. So going back to comparing similarly priced stocks, I think this could be an interesting example. So let's say you're looking at a 100 strike option with 21 days to go, and the implied volatility is lower on the like 30%. Let's say that option's worth $2, right? And you're looking at the gamma number. Whatever that gamma number is, let's just say it's 5 cents. If you're comparing that environment, $2 in premium on a $100 stock, 21 days to go, 30% IV. If you're comparing that situation to a 60% IV product, that's $100, and there's 7 days to go, but the option still has $2 in premium, the gamma is going to be relatively the same. It's not going to be aggressively different because the gamma is about the extrinsic value of that option, both at the money and out of the money, and the implication of how that moves based on intrinsic value moves. So after this, we're going to try and find an example of that.
Okay, perfect.
But at the end of the day, if you have a lot of extrinsic value to offset intrinsic value moves against you, your
less gamma
will be
risk.
low.
Yes.
Completely. That's all you need to know, really. Notional risk and extrinsic value. So there is this notion of, isn't trading high IV products risky? I like to use the example of selling a put because a stock can only go to zero. Of course, the stock can go to 1 million after splitting 1 million times, like Apple and all these other products. But Notional risk and extrinsic value, it's kind of an inverse relationship, right? So extrinsic value, of course, collecting it helps you offset your notional intrinsic value risk with short premium trades. So higher IV environments, if you're comparing a short put to a short put in a high IV versus low IV environment, higher IV environments actually have better break evens than lower IV environments because you're collecting more premium for the same strike. However, the high IV environment implies more potential risk because the option market is projecting more movement. But from a notional risk perspective, if you're selling a put and you're collecting $5 at the 100 strike versus collecting $1 at the 100 strike, you have less risk in the less monetary risk in the high IV environment, even though the market is projecting more movement. So typically that's why we like higher IV environments, because we can collect more, make our break evens better. We have the possibility of an IV contraction. But at the end of the day, we have flexibility with high IV environments, and you actually have lower notional risk if you're just comparing a short put to a short put. And last but not least, IV-based extrinsic value contractions. The reason why we try to target high IV binary events with our short options. So even if we're doing debit spreads like diagonal spreads or calendar spreads, we still want that really juicy implied volatility in the short option. It's so that we can take advantage of the IV contraction we will see after the announcement, like an earnings announcement. And why do we want to take advantage of this? Really, it's because this IV contraction can help us offset potential intrinsic value moves against us much more quickly. So just think about it as like fast forwarding to expiration, right? If you're selling a 1-day option and the next day the extrinsic value goes to 0, it's very similar to selling a 30-day option and then arriving at expiration the next day. It's the same sort of rapid contraction in extrinsic value. And that helps us in the sense that if I sell a 30-day put and the stock goes down aggressively like today in Tesla, you're going to see an increase in the value of that 30-day put because you still have 29 days to go the next day. But if you sell a 1-day option and Tesla drops close to your strike and your option is going to expire today at 3 o'clock, you don't have the same increase in extrinsic value because that option is going to expire if it is out of money. So think about that. The IV contraction helps us offset potential intrinsic value moves against us more quickly because of the lack of time and the true implied volatility exposure from an extrinsic value standpoint.
Chef's kiss.
I think that's it.
Good stuff, Mikey.